Welcome back to Berkshire Explained. Today we're doing something very specific, 5 stocks that look underpriced for 2026. Not because of hype, not because of AI will fix everything, but because the market is pricing them like the future is permanently worse than the past. The first stock is PayPal. PayPal's market cap is about $54.62 billion, and it produced about $32.86 billion in trailing 12-month revenue with about $4.92 billion in trailing net income. PayPal's valuation is where the story starts. The forward P is about 10.41 and the price-to-free cash flow ratio is about 9.82. On the cash side, in the last 12 months PayPal generated about $6.43 billion of operating cash flow, spent about $861 million in capex, and that leaves about $5.57 billion of free cash flow. If you take that $5.57 billion of free cash flow against a $54.62 billion market cap, you're looking at roughly a 10.2% free cash flow yield. That is what price for disappointment looks like in numbers. PayPal does not need a miracle to justify a much higher valuation. It needs the business to keep producing cash at something close to current levels, and it needs the market to stop assuming permanent decline. The reason PayPal can be underpriced is that a forward PE near 10 and a P/FCF under 10 already embeds a harsh view of the future, despite the company still generating more than $5 billion a year in free cash flow. The second stock is CVS Health. CVS is a perfect example of why you must look at normalized earning power and cash flow instead of taking one distorted trailing EPS number at face value. CVS shows a market cap around $100.74 billion and trailing 12-month revenue of about $391.69 billion. The trailing net income looks extremely low, about $469 million, which is why the trailing PE explodes to around 214. That trailing PE is not a clean valuation signal. It is a reflection of depressed GAAP earnings in a period that included significant accounting impacts. What matters for priced as if it's broken is that the forward PE is about 11.54 while the company still throws off real cash. In the last 12 months CVS generated about $9.11 billion in operating cash flow, spent about $2.82 billion in capex, and produced about $6.29 billion in free cash flow. Put that $6.29 billion of free cash flow against a $100.74 billion market cap, and you get roughly a 6.24% free cash flow yield. The market is also paying you a dividend of about $2.66 per share, roughly a 3.35% yield. Now here is the concrete 2026 numbers catalyst for CVS. At its Investor Day update, CVS initiated 2026 guidance of total revenues of at least $400.0 billion, GAAP operating income of $13.26 to $13.60 billion, adjusted operating income of $15.07 to $15.41 billion, GAAP diluted EPS of $5.94 to $6.14, adjusted EPS of $7 to $7.20, and cash flow from operations of at least $10.0 billion. Those are not vague aspirations. Those are specific targets the company put in writing. If CVS comes anywhere close to delivering that level of operating income and cash flow, "this is permanently broken" narrative weakens, and valuation can re-rate even without explosive growth. The third stock is Verizon. Verizon is here because the market is assigning a low multiple to a business that still generates very large, very steady cash flows. Verizon's trailing 12-month revenue is about $137.49 billion and trailing net income is about $19.84 billion. The forward PE is about 8.63 and the price-to-free cash flow ratio is about 8.13. In the last 12 months Verizon generated about $38.46 billion of operating cash flow, spent about $17.33 billion in capex, and produced about $21.12 billion of free cash flow. With a market cap around $170.68 billion, That's roughly a 12.37% free cash flow yield. Verizon also pays a dividend of about $2.76 per share, and the dividend yield is around 6.78% on stock analysis data. So the valuation picture is straightforward. You have a company earning nearly $20 billion a year, generating about $21 billion a year in free cash flow, trading at a forward P in the high single digits, and paying a dividend yield close to 7%. When you see that combination, the underpriced argument is not that Verizon will suddenly become a growth stock, it's that the market is discounting the durability of the cash flows more than the numbers currently justify. The fourth stock is Pfizer. Pfizer's market cap is about $141.57 billion, and it produced about $62.79 billion in trailing 12-month revenue with about $9.83 billion in trailing net income. The valuation is where the underpriced case starts to become obvious in numeric terms. Pfizer's forward PE is about 8.54. Pfizer also pays a dividend of about $1.72 per share, which is about a 6.91% yield on the stock analysis snapshot. Now look at cash. Over the last 12 months, Pfizer generated about $13.08 billion in operating cash flow, spent about $2.70 billion in capex, and that leaves about $10.38 billion in free cash flow. Against a $141.57 billion market cap, that's roughly a 7.33% free cash flow yield. The reason Pfizer is priced this way is also numeric, and it's important to say it plainly. Pfizer provided 2026 guidance indicating revenue of $59.50 to $62.50 billion and adjusted EPS of $2.80 to $3 per share, and it explicitly tied the pressure to falling COVID product sales and revenue loss from drugs losing exclusivity. Reuters reported headwinds including about $1.5 billion of revenue impact from COVID product declines and about $1.5 billion from patent expirations. Those are the numbers the market is reacting to. The underpriced thesis is that, even with those headwinds, the company's cash generation and dividend yield are being valued at a very low forward multiple, and the market is assuming that the post-COVID comedown is a permanent state rather than a transition period. The fifth stock is Target. Target is a retailer, so it's cyclical and sentiment can swing violently. That's exactly why it can become underpriced when the market extrapolates bad conditions indefinitely. Here are the concrete numbers. Target's market cap is about $44.26 billion and trailing 12-month revenue is about $105.24 billion, with trailing net income around $3.76 billion. The forward PE is about 12.78. Target pays an annual dividend of $4.56 per share, which is about a 4.66% yield, and stock analysis also shows 55 consecutive years of dividend growth. Now the cash numbers. In the last 12 months, Target generated about $6.77 billion in operating cash flow, spent about $3.77 billion in capex, and produced about $3.01 billion in free cash flow. Against a $44.26 billion market cap, that's roughly a 6.8% free cash flow yield. The 2026 catalyst for Target is also unusually concrete. The Financial Times reported that Target has faced a prolonged slump, including a 12th straight quarter of weak or negative sales growth, and it also reported that the incoming CEO plans around a $5 billion investment in 2026 to revamp stores and digital capabilities, with additional pressure from an activist investor building a stake. Those facts matter because they create a scenario where a deeply disliked stock can move on operational change and capital allocation alone, even before the macro environment improves.